For many investors, traditional stock investments have not been accomplishing enough for them in recent years. Simply buying and holding an investment in a portfolio through up markets and down may not be enough in the decades ahead either. Traditional portfolios typically comprise a blend of equities, bonds, and cash. Some of the most sophisticated investors, institutions, and endowments, however, have long known about another approach to investing, one that includes alternative investments to offer greater diversification during times of market stress. However, no level of diversification can ensure profits or guarantee against losses. Called alternative investments, these vehicles are well represented in the portfolios of many of America's largest endowments, including Harvard, Yale, and Princeton. One of the fastest growing of these alternative asset classes, managed futures, can play a role in meeting an individual's portfolio potential too. Managed futures are actively traded contracts based on commodities many of us use every day, from the worlds of agriculture, energy, metals, stocks, even currencies, and interest rate. Such investments may provide a strong overlay to a traditional portfolio. Investing in the commodities markets may subject the fund to greater volatility than investments in traditional securities. They allow a portfolio to simultaneously hold long and short positions in asset classes, like currencies and commodities, using a wide range of trading disciplines. Managed futures strategies can use a wide range of trading disciplines, including trend following, discretionary trading, systematic trading, arbitrage, and sector focus. Now there is a way to experience the potential benefits of managed futures in a way that is professionally managed, liquid, and available for a low minimum investment. The IASG Managed Futures Strategy Fund is managed by Perry Johnkier, who brings a 40-year track record of proven institutional experience to individual investors looking for a change. The fund acts as an intensive overlay to a traditional portfolio. The goal? Provide investors with an attractive level of risk-adjusted return. Although the fund will strive to meet its investment objective, there is no assurance that it will do so. Consider the alternative. The IASG Managed Futures Strategy Fund. Consider investments in the IASG Managed Futures Strategy Fund today. If you would like more information, call us today at 855-754-7934 or email us info@iasg.com. Investors should carefully consider the investment objectives, risks, charges, and expenses of IASG Managed Futures Strategy Fund. This and other important information about the fund is contained in the prospectus, which can be obtained by calling 855-754-7934. The prospectus should be read carefully before investing. The IASG Managed Futures Strategy Fund is distributed by Northern Lights Distributors, LLC. Member FINRA, FINRA.org. Mutual funds involve risk, including possible loss of principal. Investing in the commodities markets directly or indirectly may subject the fund to greater volatility than investments in traditional securities. There is a risk that issuers and counterparties will not make payments on securities and other investments held by the fund, resulting in losses to the fund. Derivative instruments involve risks different from or possibly greater than the risks associated with investing directly in securities and other traditional investments. In general, the price of a fixed income security falls when interest rates rise. The value of a specific security can be more volatile than the market as a whole and can perform differently from the value of the market as a whole. Using derivatives to increase the underlying pool's combined long and short-term exposure creates leverage, which can magnify the underlying pool's potential for gain or loss, and therefore amplify the effects of market volatility on the underlying pool's share price. Liquidity risks exist when particular investments of the fund would be difficult to purchase or sell, possibly preventing the fund from selling such illiquid securities at an advantageous time or price. Short positions may be considered speculative transactions and involve special risks, including greater reliance on the advisor's or an underlying portfolio manager's ability to accurately anticipate the future value of a security or instrument. Recently, the CFTC has proposed to change to Section 4.5 and other regulations which, if adopted, could require the fund, the subsidiary, and some or all underlying pools to register with the CFTC. Such changes could potentially limit or restrict the ability of the fund to pursue its investment strategy and/or increase the cost of implementing its strategy. Certain of the fund's investment strategies, including transactions and options and futures contracts, may be subject to the special tax rules, the effect of which may have adverse tax consequences for the fund. Underlying pools are subject to investment advisory and other expenses, which will be indirectly paid by the fund. As a result, the cost of investing in the fund will be higher than the cost of investing directly in an underlying pool. There is no guarantee that any of the trading strategies used by the managers retained by an underlying pool will be profitable or avoid loss. The subsidiary will not be registered under the Investment Company Act of 1940 Act, and unless otherwise noted in this prospectus, will not be subject to all the investor protections of the 1940 Act.